currently, OKR Financial will be financing companies that have applied for or received SR&ED tax incentives. So again, great opportunity to consider diversifying your portfolio, and I will turn the floor over to the gentleman now.
Thank you very much. Thanks for having us. We really appreciate it. This was kind of born out of all of our interest in having the money that we have sitting in the bank that isn't in other investments and things like that, getting bank interest rates, which I don't think anybody's terribly happy about these days. So about 2 years ago, Jason and Randy, who are my managing partners, started more of a club than a fund because they had the opportunity to fund a SR&ED loan that one of the companies had. And it kind of organically grew into 25 people and $1.7 million worth of loans. So they wanted to grow it, and I was very interested in getting involved because I was very interested in putting my money to work, not at 1% in the bank, but at something that was going to be very safe and was going to return 10% plus. So we put together the Old Kent Road Financial Fund 1. It's a $10 million offering. Of that $10 million, $8 million is committed for. $3 million has come from angel groups out west, VA Angels in particular, out of Calgary, Edmonton, Kelowna, a couple of the other small towns. There's a quarterly yield. That's a 10% yearly payout that pays out quarterly. It's RRSP and TFSA and RIF eligible, and it specializes in these highly profitable government-backed SR&ED loans. I'm not sure where the button is, the clicker. What do I press here? Does anybody know? The one on the right? Okay. So it's a 10% interest rate plus 50% of the interest paid above what AMI, sorry, this is our new presentation, and this is the first time I've had the opportunity to present it, but AMI was the previous company. So they had an internal rate of return of 41% because their money was fully invested all the time. Only invest in government-backed securities like SR&EDs. The three partners, we have access to hundreds of deals through angel and grant community and partner relationships with accounting and SR&ED consulting firms. So as I mentioned, Jason and Randy started this and had a 41.37% return over 18 months, which is pretty amazing. And no defaults, no difficult to cover loans, low risk, very high return. Here's a bit of a history over 6 or 7 of the different funds and the duration of those loans, the return of investment and the internal rate of return, which was 41.3%, which is not what we expect to get in our fund because I can't imagine we'll have all 100% of the money invested all the time. I'm sure it'll be more like 80%. So, but that was the return that they got. There's myself, there's Jason Neale, who is with me today, and there's Randy Thompson, who is not with me today, but Randy started VA Angels out west, and they have 5 chapters as well. So I've got 30 years of experience starting and mentoring companies, specializing in financing and negotiating mergers and acquisitions, taking companies through raising money, raised over $100 million in my career in all kinds of different things from wineries, agriculture, healthcare, all kinds of things, mining, film and media, and high tech. Jason Neale, who's over there, was the 2009 Ernst & Young Entrepreneur of the Year Award in Quebec Emerging Entrepreneurship, and the 2009 NRC Leader in Innovation winner, the 2010 Deloitte Fast 50 top CEO, and raised $130 million over his career, and he specializes in M&A, business turnarounds, and has a tremendous relationship with the government and all of the different government programs. Randy Thompson, he's the founder and CEO of VA Angels. It's Canada's most active angel forum. I hate to say that here because I don't know. Startup Canada Group voted 2014 Angel of the Year. He founded the Alberta Supernet and Khyber Pass Entertainment and is involved in many community initiatives like the A100, VA Angels, Venture Alberta Magazine, and Alberta Information and Science. And he's an advisor to the province of Alberta as well as companies in Puerto Rico and the UK. So the programs we finance are scientific research and experimental credits. These are all of the other programs, and you can see by this chart that SR&ED compared to everything else, is really the giant in the room. It's the elephant in the room. It's a $4.7 billion program. Our ideal target loan already has a successful track record of claims, already works with a recognized CEO or accounting firm. They've got successful cash resources to fund the cash flow, and what they're looking for is a loan to fund the receipt of the tax credit, and obviously we're looking for the repayment of that OKR loan and validation of accrued financial credits with the government. And the partners that provide our deal flow are all of these different companies from PwC, TSGI, Angel Groups, Forge Capital, Banff Venture Forum. And one of the things that I'm doing this week is spending a lot of time visiting accelerators in Toronto and things like that to really boost up the amount of deal flow. We're going to need 80 to 100 companies a year, which is 8 to 10 deals a year, which is not, or a month, which is not really very many. So the shred refund process, I'm going to turn this over to Jason to kind of explain this.
Okay.
That button.
Okay.
On the right.
So I'm the techie, so I get the complicated graph to talk through. Apologies for that. I'm guessing that everyone in the room knows a lot about shred, but for those that don't, give a quick summary. This is sort of the life of a typical company. So imagine they had a $600,000 shred claim expected in a year, so they're accruing effectively on their books $50,000 a year. And what would typically happen without us, or without access to capital, is that they would accrue $50,000 each month. So you see it going up there to $100,000. So a whole year has gone by from the moment they started incurring this expense. They then file their shred claim with their tax return sometime up to June, and most tech companies unfortunately don't file it every month. It's normally 6 months on the day, and I've been guilty of that myself a lot of times. The last day of the financial year, and if they're really lucky, they'll go through an audit and they'll get their money back about 2 months after that. So you can imagine, from the moment I start incurring this expense right the way through to September of the following year, I have access to this capital. And what we do is on a quarterly basis, when we can validate that shred, we can justify that, we will loan them 65%. So you see the cash disbursement here, 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 and here. So they've got access to a large part of that capital as they go through the year. We limit it to 65%, so we limit the risk. So that's how we work. In terms of distribution of revenue, so the loan revenue comes in, management takes a 2% fee, investors take a 10% preferred return, and then it's a 50-50 split between the management and investors. So we're really incentivized to deliver success because we know the first 10% is going to the investors, but a lot of the upside ends up with us, and that's deliberate, and it's deliberate to make sure that we can achieve good results. So typical ways that we offer a loan and how we make money. We have two programs. It's kind of like whether you decide to take a taxi or a limousine to the airport. So this is the taxi model, and I probably should have a nice picture of a taxi up here. So imagine a company takes a loan of $200,000. Typical interest rate is 2.9% a month. They take it for 6 months. The return to us is $37,000, which is about a 40% return on investment. And we have a whole queue of companies either in play now, or loan to now, or about to be. Other option is a limousine, so it's a company that doesn't have a lot of confidence, or doesn't want to risk a recurring monthly interest rate, so we charge them a flat fee of 21%. If it takes them 3 months or 1 year to get their shred back, it doesn't matter. There's actually a lot of companies that like that. And imagine it's a 6-month return. In this case, we get $42,000 back, so a repayment of 42%, and we end up at 46%. A couple of times last year in AMI, we hit what was called the criminal interest rate. So we have in our loan agreements that we cannot charge more than the criminal interest rate. And it's a really interesting conversation when you go to the company and say, I've got really good news for you, but it's not going to sound good. Okay? The really good news is in Canada there's this thing called the criminal interest rate, and unfortunately for us, you just hit it. So we're only going to charge you 30% or 50% of what we thought we were. Really interesting to see their faces. So that's how it works. I said about 20% of the loans ended up hitting that 60% return rate. So again, this is an example. Typical $25,000 investment, return on investment 41%. So you get a $10,000 return. First $2,500 goes to the investors, $500 to the management, remaining profits at $7,000, which they get split 50-50. So you end up in that case, in this example, with a 25% return. So worst case 10%, best case 25%. Okay. I think I was going to you now. Do you want me to
Go to the next one.
Okay, so this just again summarizes the units, Class A, 10% return to the investor, 50% of the profits, and management has 2% management fee and 50% of the remaining profits. You want to close?
Sure.
Can't do this seamlessly. So.
Almost like taking a commercial break.
Thanks very much. So it's an excellent vehicle for investors that are looking for consistent cash flow. It's a portfolio of companies. When this started out, it was more of a club where we would go to people and say, hey, we got a $100,000 loan. Who's interested? Send out the emails. You'd be involved in one company. It's no longer like that. This is a portfolio of companies. So should one fail, although out of 19 companies that have been done so far, none of them have failed, none of them have been difficult to deal with. It's an excellent risk-reward ratio. We're investing in growing companies. It's a real niche product. There is competition in the area. There is nobody who's established themselves as a real name in this area, and that's something that we'd like to do, and we'd like to be able to grow this into a much larger company. We looked kind of long and hard at what the number is that we should have, and we felt that the first number we should be looking at was $10 million, because it was something we were very confident we could deal with, get invested very highly percentage-wise, and get the kind of returns we're really looking for. And previously, these kind of investments were only available to high net worth individuals, which I'm sure many of you or most of you are. But this is also being offered to friends of yours, family, whatever, through RSPs, TFSAs, whatever it is that works for people. It's an exceptionally good vehicle in a TFSA, for example, because the money flows right in there totally without any taxes whatsoever. So my name is Neale Linder. I'm going to just look at these extra slides that we have. The engine that drives Canada's R&D is really the SR&EDs. It's been a staple of government policy for 30 years. It was as early as 1944. These were in play. Annually, 20,000 companies receive grants from SR&ED. 20,000 of those are big companies. They don't need us. 20,000 of them are small to medium-sized companies, and they need help with this. And one of the reasons that it's really good for them to do is they don't have to sell equity. They can do this instead, and although it's expensive, it's not nearly as expensive as equity. So this is kind of how we manage our risk. We allocate points to the different kinds of things that they've done before, and all the things that we know are very important so that they don't fail and our loans don't fail. And if you'd like to talk more about that or ask more questions about that, we'd be happy to answer it. And that's it. This is something that is designed for your extra money. This isn't like the deal before or probably the deal after. It's designed for the money that's sitting around in bank accounts, not doing a whole lot, looking for bigger returns in a safe way and managed by good people. Thank you very much.